Housing affordability in Canada is getting even worse or even harder to attain. And this was exemplified this week in RBC, who put out a housing affordability measures chart, which essentially showed that the home ownership cost as a relation to the percent of median household income just hit an all-time high of 60%. 60% of your income is required to buy the average Canadian home, which is in the 700,000s. Vancouver, obviously a whole different ballgame here. And so this is increasing what they call affordability gap in Canada, which is essentially the difference between what a home costs and what the household can actually afford. That gap is upwards of 67% now, meaning you can afford X and typical home costs 67% more. But what's really fascinating is how quickly or how much that percentage has grown. Because if we go back just to 2 years ago, just not even 2 years ago, a year and a half ago, December of 2021, that was down at 45%. If we do go back 2 years ago, that drops all the way down to 20%. And if we want to go back a whopping 7 years to 2015, the affordability gap was only 2%. That goes to show how much things have increased in just the last 7 years here. And after 6 rate hikes in a row, the Bank of Canada is set to increase one more time here in October. So what is that even going to mean for housing?
I think we're at a place right now, Dan, where it gets far more difficult, I think, not only I think I said this last time in our last pod, but far more difficult for the Bank of Canada this time round than I think it does for them any time in the past since they started raising rates. We're getting into a very difficult time now. This time where affordability is, like you said, it's at an all-time high. They're really squeezing Canadians. And that wealth effect, that negative wealth effect is really taking place here. So anyways, guys, Ryan Dash here and Dan Wertel with the Vancouver Life Real Estate Group. And want to thank you, first of all, for joining us today on today's episode. We make educational videos for our online community to make sense of this crazy, crazy world of real estate that we're in. Really appreciate it if you hit the subscribe button, smash those likes, hit the bell so that you don't miss another episode like this. And please, by all means, please share this with your friends and your family as it helps the algorithm and other awesome people in our online community learn about what we're going through. Anyhow, so let's touch on the markets, because the markets are as much of the conversation, I think, right now. They are the best way of looking at the liquidity that's currently floating around. And the Dow had its worst month since March of 2020, since the pandemic or the lockdown took place. We are down roughly 30% off its highs from 2022. And this is the worst quarter for the S&P since 2009. So really, really, really feeling a significant correction here, significant wealth effect, negative wealth effect, and demand destruction taking place. Canadian household debt to disposable income continues to climb, hitting an all-time high here in August of 182%. The USA, by comparison, is at 100%. That's staggering. Unemployment rose for the third straight month, though there are still over 1 million job vacancies. And this is due in part to the fact that many people are retiring, and COVID and the lockdown certainly propelled some of that. There's people that are just also not going back to work. You look at 225,000 people retired in 2011 compared to 2021, where 305,000 people retired. So lastly, consumer insolvencies jumped 18% in June, led by BC and Ontario, a couple of the most expensive provinces here, though still over 30% lower than the pre-pandemic levels.
Lots of influencing factors. And of course, we look at all these metrics and how they do actually affect housing. And right now I want to get into a bit of the inventory numbers because I find this still the most fascinating metric to keep your eye on as we go through the next 6 to 12 months. Because nationally, if we look at inventory, we're up about 25% year over year. Ontario, which has been leading the way unquestionably with this turndown, they've seen an 89% increase in inventory year over year. Now, let's not get too far ahead of ourselves. Do remember that year ago, it was the lowest on record. So yes, they're coming off of a very low baseline, but still, when you go up almost 90% in a year, it is noticed. BC as a whole is up about 36%. There's about a third more homes on the market than there were this time last year. But, and this is what I find the most interesting, GVRD in comparison is actually lower inventory than where it was this time last year. So you're up 23% nationally, 36% provincially, and you are negative when you get into our little town here of GVRD. And this isn't just a one-off. We're talking 5 months in a row now. We've been at or below the last year-over-year averages. So this is a very unique metric to be paying attention to because, of course, we're not seeing panic selling. Again, sellers know that they can hold off in this little town of ours because should history repeat itself, they know this is a cycle and they know prices are going to swing back up at some point. So if you're looking for a February, March number and those are long gone now as a seller and you can hold on, you're going to. And that's exactly what we're seeing out there right now. So again, looking nationally, new listings dropped about 5.5%, and that's following the 6% that we saw in July. So while sales are low, new listings are low. And inventory is simply not building. It went up just 0.4% last month, which for reference is the smallest increase we have seen for all of 2022. And this is in September, typically a huge listing month. This is the beginning of the fall season, which right now is almost non-existent. So as mentioned, Ontario, pretty much the epicenter of this downturn. I mean, sales there are back to like 1990s levels with obviously more population than there was then. But August saw listings fall for the first time since 2021. Can you see the very early stages of a potential signs of the bottom? No, it's not the bottom. No, I'm not saying it is. But again, you start to see a couple metrics poke their head out and it says, okay, cool, things might be shifting or at least flatlining like they are here in Vancouver. And for reference, again, sure, we're talking about things being bad, but keep in mind, active listings are still 50% lower than just 7 years ago in 2015. That's both for Ontario and nationally. 50% lower than 7 years ago with obviously higher population numbers. And a quick month of inventory reference to nationally, we're sitting at about 3.5, well below the 10-year averages of 4.5 months of inventory. And it takes a lot for it to increase up to that metric.
And just out of curiosity here, before I get into some more metrics that support the argument, why do you feel like Vancouver is different in this respect to maybe the rest of the country? Why are we seeing flatlining, comparatively speaking, to say something like Ontario that's up 89%?
Because largely we have the same housing crisis we had when people were freaking out 6-7 months ago. People know that if they sell, there's not much else out there for them. That's part of it, okay? And this is, again, based on largely the immigration numbers that we'll get into in a bit. Vancouver is largely not as overextended as well. Our debt numbers are well below the national average, so people aren't having to panic sell to try and just come up with money for living expenses. And of course, here as well, we have an above average amount of owners that are mortgage free. So those are a few of the reasons. I'm sure you can contribute to a few as well.
Yeah, well, honestly speaking, for me, there's also major geographical constraints that already exist, right? Like anywhere else in Ontario, for example, much wider in terms of where they can grow and how they can grow. Vancouver is very limited. Typically, we can only go up, certainly in the downtown core. You start looking at places like Squamish, and you have to go further out to accommodate living close to the city, and that costs money, right? And a lot of people aren't prepared to give that up either. But I really also think that population growth has a lot to do with that. And we're going to touch on that because some of those numbers are actually incredible. For now, let's talk about the sales to active ratio. That is one of my favorite stats to look at. So the sales to new listings ratio, which is an interesting one, has rebounded for 2 straight months. We're 1 month away from a trend here. We're back to 2018, 2019 levels, which were hardly a disastrous time for Canadian housing. And encouraging news hasn't really hit the public yet. We haven't really had very good inflation news. We have had terrible interest rate news. And the real estate outlook and sentiment is still very low, as bad as 2016 and early 2020. And I would also argue that looking at other, the fear and greed index on Google, when it comes to the marketplace, is still looking at extreme fear. So the sentiment there is what we need to pay attention to. But the change in trend is getting very interesting. Largely, though, this is because mortgage payments required to purchase a typical home are up 52% from this time last year. So they're up about $1,050, just over $3,000 a month. So keep in mind here, from 2016 to 2021, that same mortgage hovered between $1,500 to $1,850. Now that's over $3,000. So the same could be said for rent as well. They're both rising at an incredible rate. I know which one I'd rather have, but at the end of the day, looking at $3,000 a month either way, we're talking about affordability. And at the end of the day, it's not affordable for anyone.
Right. So all these metrics really point to consumer confidence just falling through the floor here. When stock market is getting hammered, when interest rates are high, when mortgage and rent payments are super high, with insolvency starting to rise, all these things obviously affect housing sales. One of the first things you're going to not do is spend a lot of money if you feel like your wealth is being deteriorated. So sales here nationally fell another 1% month over month. And honestly, we're about 42% below the peak as far as sales volumes for a singular month goes. Again, Ontario, my goodness, they're back to like 1990s days. And of course, prices are taking a hit as well. Prices dropped HPI nationally about 1.6% last month. And for reference, that is a faster drop than any we saw during the global financial crisis. That's a big number month over month HPI. And keep in mind, I mean, sure, we're down about 8% now HPI from the peak, but HPI is very poorly represented to real prices in a fast moving market like this. I think we could easily say that is double right now, more like 16% nationally if we're going to take average and median into play, as we should. Because, I mean, you look at Ontario, look at BC, quite easy to look at areas that have a 20% below peak price point when we're talking about both median and average. Coquitlam, for example, is easily there right now. Let's take a quick look at our GVRD numbers because we're recording this on Friday, September the 30th, technically a holiday. No sales are registering today, so the monthly data for September is in. 1,709 sales for the month of September here in GVRD. The big news you will hear is that is a 45% drop compared to this time last year. The only slower Septembers, and you'll probably recognize these years, 2008, global financial crisis, 2012, huge down market, and 2018. All down markets, and of course, we are seeing prices go down here as well. Interestingly, I will point out that while median prices dropped about 6K in the month of September here, average prices actually increased. Now we're going to see HPI drop as well. But again, when we're talking about early signs of, the bottom here, these are the kind of things that start to poke their head out. Again, no comments are needed yet. I'm not saying it's the bottom. I'm not saying it's happening, but this is how it starts. As little metrics start to poke out. When you're used to all 3 or all 4 or all 10 pointing down, then 1 or 2 start to point up. That's the beginning of things shifting here. Again, anything can happen next month. We are on the verge of all sorts of potential mayhem here on a global basis. So way too early to call it. But again, interesting to see a couple of things ticking upwards in the August and September numbers here.
or at the very least stabilizing. Yeah. I also think variable rates and fixed rates. Let's talk a little bit about them because those rates apparently are converging now. So the attractiveness, if you will, of the variable rate product used to be extremely attractive because it was so much cheaper. But now we're seeing the rates are roughly in and around the same amount. So variable rates have priced in this 75 basis point hike from the Bank of Canada earlier in the month, while fixed rates have continued to tick down. Both fixed and variable rates are now averaging around 4.5%. And that spread that was roughly 200 basis points between variable and fixed has all but closed now. So it really is now going to become a decision of where do you think rates are going in the next 5 years? If you're going to buy a house today, are you going to lock in because you think in the next 3 to 5 years rates are either going to stay where they are or they're likely going to go higher than a fixed rate mortgage is probably for you? I tend to think that we're going to see more movement out of the economy. And I think while it may go up a little bit in the short run here, I think over the long term, we're going to see that come back down. So it'll be really interesting to see what happens here with variable rates in the medium term. Even still, variable rates still account for about 50% of all new mortgages, but that number is now trending down. Total amounts of new mortgages is 20% lower than it was this time last year. I don't think that that's a huge piece of news. Really, we're back to mid-2020 levels. So,
yeah, not too much of a surprise again. If you're not buying a home, you don't need a mortgage. So that number we can definitely expect to trend downwards. And speaking of home ownership, I remember the first time I ever visited London, England. And back then, this is decades ago, home prices, even then, were absurdly high, at least in comparison to back home here. And I was asking some of the people there that, how do people afford it? And they largely said they become generational homes. A lot of the new, younger generations, they couldn't afford it. And I felt the same sentiment when I visited New York and saw some of the prices there. And it's now having a similar effect in Canada. Obviously in BC, especially, of course, Vancouver area and, of course, the Toronto area, prices are so high that a lot of people can't afford it. So home ownership rates in Canada are dropping. In the last 10 years, the percentage of home owners have actually dropped about 4%. I believe that number today is somewhere around 66% compared to 70% where it was. And for the younger generation, again, this is kind of really speaking truth here. For the 25 to 29-year-olds, there's been an 8% drop in home ownership in the last 10 years. Now, largely that's going to do with price, I think. Yes, there's a shifting dynamic in that generation as well about not needing to be a homeowner. But if you also don't have the choice, you may be looking elsewhere for things to do and where to spend your money. Now, on the flip side of that, condos are typically the first purchase for a lot of people, obviously in these urban areas. Condos under construction are currently up 2,000, and they're at a new high right now, a new record high of about 150,000 condos are under construction nationally. It's a big number. It can help towards where we're going. Of course, this might freak you out a bit as well, because it definitely shook me. 40% of properties built in the last 5 years were bought by investors. Wow. And typically those people were leveraging their existing home equity to buy into those, meaning that they could kind of beat out the, let's say, first-time home buyer trying to buy into that same condo. Well, in a bidding war, that person with a little bit more equity is going to typically win every time.
Yeah, so, they can draw on it, right?
What's that?
They can draw more on it, whereas somebody who's just using bank funds, they get capped out. Yeah, exactly. So, I don't know, population, though, is going to eat that up. Ryan, why don't you talk a little bit about this population that we're seeing, because these numbers are also fascinating. Yeah, whereas we're typically seeing, in the last sort of, I want to say 3-4 years, we were seeing high 300s, low 400s in terms of total immigration year over year. However, in the second quarter, Canada's immigration grew by a whopping 284,000 people in Q2. So to give you some context, this was the highest growth in number of people in Canada of any quarter since the addition of Newfoundland. My goodness.
You had to add a whole province to beat this.
If you're trying to figure out how the Canadian government is going to make sure that they have enough taxable income to pay for the coronavirus and everything else that they're trying to do, here's your answer. It's coming in through a lot of new people, a lot of new income tax, a lot of new property tax, all of that kind of stuff here. This is their way out. I don't think that's really
that's
secret.
A quarter. At that rate, they would be bringing in over 1 million people per year.
Yeah, that's huge.
For the country, yeah.
That's huge. So our population is growing more than twice as fast as it was in the 35 years before 2015, which of course is contributing to today's high home prices and high rents, impacting families across Canada. So what's going to be the result of all these new people coming in? Is 150,000 new condos really enough?
I was watching the news earlier today, and they were talking about the gas prices here in Vancouver being the highest in North America. And they were saying it was a supply issue. They said because of the lack of supply, prices were going up. Very novel idea. And funny that people still deny that all the time. But regardless.
You'd think as a country, as the fourth largest producer of oil globally, that we wouldn't have these massive issues. I mean, you got to remember, I want to say roughly 50% of what we pay for fuel in BC is carbon tax and tax. So there's a lot of contributing factors there that make it the most expensive. Anyways, why don't we talk a little bit about our predictions here going forward for the next month and a half? It's really hard to look beyond that in this market.
For sure. We always like to give our best insights into what we think is going to happen, at least in the next upcoming 3 to 4 months kind of thing. And we definitely do appreciate everyone who reaches out, calls us, and asks about, again, our predictions for their specific scenario, because, obviously this is somewhat wide reaching. And so every person has their own individual needs, desires, and situations. And of course, we're happy to talk to them. But, talking a little bit more widely here, prices, sure. Like I just mentioned, we've got 2 of 3 metrics ticking down in September in GVRD. We got one of them ticking up. Are things going to stabilize? Possibly. Because again, we're seeing, and when I say stabilize, I'm talking about pricing here. We've got a number of areas that are sitting around 20% off of the peak. We got HPI at 8 or whatever it is here. It's obviously going to go lower next month, around 9, maybe even 10 kind of thing. My prediction of that hitting 15% at the bottom, I'm still holding on to that one until the bitter end here. But again, I think we're going to start to see through the next few months here, based on the habits that we've seen, 5 months, inventory not increasing, no panic selling, seller or buyers on the sidelines as well. We're going to start to see prices go sideways. And I think they're going to go sideways more or less, give or take a point here or there into the new year.
Choppy, as you would say.
Yeah.
Another big story here. What's going to happen with potential recession for next year? You look at a lot of the other G7 nations, it's not looking great. I mean, if we consider the UK pound for 1 second here, trading at near parity with the US dollar, that hasn't happened in some decades. Now, will that be the case forever going forward? Unlikely. But in the near future, there's definitely recession on the forefront. And I think while we have our own micro pressures here in Vancouver, I think nationally speaking, it's probably not going to be that great over the next 3 to 6 months. The other thing that I want to touch on, and I've had a lot of conversations with this now with a lot of clients, a lot of people saying, well, hey, with the Nord Stream pipeline going down in Europe, that spells, some potential business opportunities here for all of the oil we've got in Canada, but it doesn't. And I hate to burst everybody's bubble here, But when you're needing to supply Europe with the amount of natural gas and fuel required to get them through this winter, it would take us nearly 3 years to ramp up that level of production. So by the time we would be even able to produce that amount, we would have missed the whole boat. We needed to produce these natural gas plants that we had originally planned to do a decade ago. Then we could have seized this opportunity. So I don't really think that there's an economic boom coming for Canada in that energy sector, at least not yet. With that said, Alberta is pumping right now, and they're doing about their critical levels of production that they've currently got capacity for. So very interesting time right now for Canada in terms of how we go through as an economy. And I think for our housing sector, we still have so many micro pressures here in Vancouver that are different than the balance of the country, that I think we're going to see a resilience that probably the rest of the country won't typically see.
Interesting that you're talking about Alberta and sort of the production levels there, because there's all sorts of headlines right now talking about the intermigration into that province, largely because of housing prices, far more affordable than most of Ontario and most of British Columbia. And of course, jobs abound. Where do you go when you need a job or you want to have more affordable housing right now? For many, it sounds like Alberta is quite an attractive option. And while things are quite bleak, if you look at it through one lens, let's also remember, Ryan just touched on the fact that the stock market just had its worst month since March of 2020. Okay. The people that, let's say the fund managers, people who play the market, and a lot of these portfolio managers have told me many stories about some of the greatest wealth they ever saw created was post March 2020. And if we're looking at the stock market acting in a similar way, they honestly are, what's the phrase, chomping at the bit, because they know the opportunity on the other side of this. It doesn't matter if numbers go up or down. You can, in the right markets, make money either way. So not to say it's negative or positive, but there's always opportunities. So again, yes, times are tough. Things are going to get more expensive. Mortgages suck right now for the most part. But again, there's also all sorts of opportunity on here. And maybe on that note, Ryan, we'll do a podcast soon on all the great ways that you can leverage an economy and a recession. Because again, some of the biggest generational wealth that's ever been made are in environments similar to what we are about to go through here.
If you're speaking to traders or if you're speaking to people in the finance industry, these are the kinds of things that come along once every 7-10 years. And you position yourself correctly for coming out of this in the right way, you can do very well and create even generational wealth if you play it correctly. Now is the right time to be asking those questions, to be positioning yourself, to be figuring out how can I benefit from where we are and where we're going.
There's an immense amount of fear out there, which means there's an immense amount of opportunity. So the other way, get professional advice and happy investing. We'll see you next week.